Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that is all about raising money, and when companies try to raise money, it often means things are either going really great or they're a bit desperate. Let's see which it is for Talphera Inc. This is a registration statement, a Form S-3, filed with the Securities and Exchange Commission. Essentially, it is Talphera telling the SEC they want to sell more stock. But in this case, it is not the company selling it directly. It is the people who already bought stock or warrants from them and now want to sell those to the public. Think of it as them wanting to cash out some of their investment. So this document was officially filed on the 28th of October 2025. It is for what they call a resale of shares. This means Talphera isn't getting any cash from this particular sale. All the money goes to the shareholders who are selling. This is a pretty common move, especially for companies that have recently raised money through private placements. Right here, they're calling it a preliminary prospectus. This is basically a heads up to investors, saying here is what we're planning to do, but it is not set in stone yet. It also warns that the information isn't final and could change. It is a way to get the ball rolling with regulators before the real offer to sell begins. They're looking to offer a little over 1 million shares of common stock. This is the stock that people can buy directly, and then there are these pre-funded warrants. Now, warrants are like options that give someone the right to buy stock at a certain price. If you see pre-funded, it usually means they've already paid most of the price for the stock that the warrant represents, and they're just exercising the warrant to officially get those shares. So, in effect, they're looking to sell almost 2.8 million shares in total. These shares and warrants were originally bought by the selling stockholders back on the 31st of March 2025. That is when Talphera likely sold them in a private deal, probably at a discounted price, to get some quick cash or as part of a broader financing round. Again, super important, Talphera itself isn't getting a dime from this sale. All the money goes to the people who bought these shares and warrants earlier. They're just facilitating the resale. So, where does this stock trade? It is on the Nasdaq Capital Market under the ticker symbol TLP. And just before this filing on the 27th of October, the stock was trading at $1.26. That is pretty low, and it gives us a clue about the potential price range for this resale. Now, they always put this in, but it is worth noting investing in our common stock involves a high degree of risk. They're telling you up front to be cautious. We've got the usual table of contents here. Guiding us through the document, we'll skip over the really dry stuff, like legal boilerplates and contact info, and focus on what really matters for understanding the company's situation. The prospectus summary is always a good place to get the gist of the whole document. Scroll Talphera Inc. Overview scroll. Let's look at what Talphera does. They describe themselves as a specialty pharmaceutical company focused on developing and commercializing therapies for medically supervised settings. Their main product candidates include NIARD for dialysis, LTX-608 for things like DIC and ARDS, and 2 pre-filled syringe candidates. Their strategy is really centered on NIARD. This section elaborates on that private placement we saw mentioned earlier. On the 31st of March 2025, they sold stock and pre-funded warrants. The price was $0.586 per S-hair and $0.585 per pre-funded warrant. They raised about $1.6 million from this. That is not a massive amount for a pharmaceutical company, especially considering development costs. And as confirmed again, Talphera gets nothing from this resale. The selling stockholders get all the money. This is just about their investors getting liquidity. This is usually a dense section, but it is crucial. They're essentially laying out all the ways this company could fail. They refer you to their annual reports for the really in-depth risks, but they highlight the need to consider things like future financing, managing operating costs, cash burn, and the general volatility of their stock. This part is a legal disclaimer. They're saying that any statements about the future, anything that uses words like may, will, or expects are just predictions. They aren't guarantees, and a lot of things could happen to change those outcomes. They are essentially saying, don't bet the farm on what we say about the future. Here we get into the nitty-gritty of their stock. They have 200 million shares of common stock authorized and 10 million preferred shares. As of the 25th of October 2025, they had about 46.6 million shares outstanding. Scroll common stock voting rights is scroll when it comes to voting. Each share of common stock gets 1 vote. So, if you own 1 share, you get 1 vote on company matters. Now, about dividends, they say holders of common stock are entitled to receive dividends if the board of directors decides to issue them, and if there are legally available funds. Pretty standard language, but it doesn't sound like they've ever paid a dividend, and it is unlikely they will anytime soon given their stage. In case the company goes belly up, common stockholders get to share in whatever's left after all the debts are paid. They're last in line. They also have preferred stock, which the board can issue with different rights and preferences. This is often used as an anti-takeover measure or to tailor terms for specific investors, but there is no preferred stock outstanding right now. This part deals with how their company structure and Delaware law make it harder for someone to suddenly take over the company. Think of it as making it more difficult for hostile takeovers. They have a classified board, meaning directors are elected in staggered terms, making it harder to replace the whole board at once. They also have provisions that limit when stockholders can act and require advance notice for proposals or nominations. Plus, Delaware has a law called Section 203 that puts restrictions on business combinations with interested stockholders for a period of time after they acquire a significant stake. All of this is designed to create stability, but it can also make the stock less attractive to certain types of investors or activist shareholders. This section lists who is actually selling the shares. One of the big sellers is Intracoastal Capital LLC. They're selling over 1 million shares initially, and they hold warrants too. The other major seller is entities affiliated with Empri Asset Management LP. They're set to sell over 1.7 million shares, which are tied to those pre-funded warrants. Scroll beneficial ownership prior to this offering. Scroll looking at their ownership before this offering. Intracoastal Capital has over 1.7 million shares related to warrants and stock. Empri Asset Management and its affiliates have over 1.7 million shares, mostly coming from exercising those pre-funded warrants. This is how the selling stockholders plan to unload their shares. They can sell them on the NASDAQ through brokers in private deals, or any other legal method. The key here is that they're not restricted to selling only through this prospectus. They can use other exemptions if they want. Talphera is footing the bill for all the costs associated with registering these shares, like legal and accounting fees. The selling stockholders just have to worry about any commissions or discounts they might pay to their brokers. Scroll Part 2 information not required in prospectus to scroll. Now we're moving into the more technical part of the filing, the Part 2. This is where they detail the costs associated with this registration. The SEC registration fee is listed as a very small amount, just $432, which seems almost negligible. Total estimated expenses are around $100,000, covering things like accounting, legal fees, and miscellaneous costs. The FINRA filing fee is not estimated here, likely because it depends on the actual amount of securities sold. This section talks about how Talphera protects its directors and officers. Delaware law allows companies to limit personal liability for directors, except in cases of bad faith, intentional misconduct, or personal gain. Talphera's bylaws also mandate indemnification for directors and officers to the fullest extent allowed by law. And they provide advance payment of expenses for legal proceedings. They also carry liability insurance for their directors and officers. Importantly, they acknowledge that indemnification for liabilities under the Securities Act might be against public policy, and therefore unenforceable. They're basically saying they'll follow the law and their internal policies. But they can't shield people from all legal troubles, especially those related to securities law. Here is a list of all the documents that are attached or referenced in this filing. It includes their charter documents, bylaws, and importantly, the forms of their securities purchase agreement, registration rights agreement, and pre-funded warrant, which were all filed on the 2nd of April, 2025. This is a standard section for registration statements. Talphera undertakes to file post-effective amendments to update the prospectus with new information, reflect fundamental changes, or include updated distribution plans. They also agree to remove unsold securities from registration via an amendment. It is essentially a commitment to keep the prospectus current and compliant. Now, let's put on our Warren Buffett hats and look at the bigger picture here. Talphera is a specialty pharmaceutical company, which means they're likely operating in a niche market with high development costs and regulatory hurdles. The fact that this filing isn't about them directly selling new stock for operational funding, but rather about their existing investors selling their stakes, tells us a few things. Firstly, at $1.26 per S-Hair in late 2025, the stock price is quite low. This suggests that the market's current valuation of the company isn't very high. The original purchase price for these shares was around $0.586, so at least some of these selling stockholders might be looking to realize a profit. But the $1.26 price point suggests that maybe that profit isn't as substantial as they'd hoped, or perhaps some bought at higher prices and are looking to cut their losses. The company raised $1.6 million in March 2025 through this private placement. For a pharmaceutical company, that is a relatively small amount of capital. It might be just enough to keep operations going for a short period or fund very specific early stage development activities. They also mention a going concern in their auditor's report, which is a big red flag. It means the auditors have doubts about the company's ability to continue operating for the next year. This strongly implies they will need significant additional funding. And soon, the risk factors section, where they refer to their 10K, is where you'd find out if they're facing existential threats, without diving into those specific risk filings. The general statements about needing additional financing and managing cash burn are the most critical takeaways here. They are clearly in a situation where they need more money to survive and grow, and the low stock price makes raising that money through equity sales very difficult right now, without significantly diluting existing shareholders. Selling existing shares, as seen here, is more about providing liquidity to early investors rather than fueling growth. The complex corporate structure and anti-takeover provisions are standard for a Delaware corporation, aiming for stability, but they don't change the fundamental financial picture. The company's future hinges on the success of its product pipeline, particularly NIAD, and its ability to secure substantial funding. Given the low stock price and the auditor's going concern note, the immediate future looks challenging, and they will likely need to either find a significant investor, a partner, or another financing round that might come with tough terms for current shareholders. So, what is the story? Talphera is in a tough spot. They're trying to develop innovative therapies, but they're clearly struggling with funding. The current filing is less about the company's operational progress and more about allowing early investors to cash out. While the low stock price might present an opportunity for some, the underlying financial health and the need for significant future funding present substantial risks. It is a classic case of a development stage company needing more capital to push its products forward. Alright, that is our breakdown of Talphera's -3 filing. What is your take on these numbers and what they signal for the company's future? Do you see this as a chance for investors or a sign of deeper troubles? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives into corporate documents. Don't forget to check out the Discord community linked in the description below for more discussions and insights. Thanks for watching. See you next time.